Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically we have covered several topics in it. Okay, so far. So basically in this lecture we are going to start with another important topic or the series which is known as the financial institutions. Like what are the institutions which we call as the financial, banking or non-financials whatsoever. Okay. So basically these are the topics we have scheduled for discussion under this series. Like we will start with the introduction. Okay. We will start with the introduction of financial institutions. Then we will see the Department of Financial Services. Then the classification of institutions, supplemental financial institutions, types of financial institutions, NBFC types, and the conclusion. Okay. So these are the topics we have scheduled under this particular area. Okay. So basically, if we talk about it, so we will discuss them one by one, okay, in a proper sense. And what we will try to understand the overall financial sphere. Okay, so let's start. First, we are going to see the introduction of the financial institutions. Okay. Financial institutions in India play a pivotal role in the country's economic development by mobilizing saving and facilitating investments. These institutions encompasses a wide range of entities including banks, non-banking financial companies, insurance companies, pension funds, and the stock exchanges. Okay, so if you look at this, what you are seeing right now, basically we have identified some words here like the economic development we have seen. Second, we have seen mobilizing savings and facilitating the investment. Okay, and then we have seen that what are the components of the financial institutions: banks, non-banking financial companies, insurance companies, pension funds, and the stock exchanges. Okay, these are the things. So basically, if we try to talk about the first one, which is known as the mobilizing saving and facilitating investments. So basically, you could say there is two parts: savings, investments. Okay, so savings are oftenly considered as a excess of amount, right? While the investment is often considered as a okay, there is one thing: savings, investment. Okay, just write down them. Okay, here is borrowing, or you can say credit facility. Okay, so if we look at this picture, savings are the investments, they are always in the excess of amount. Okay, whereas when we talk about the borrowing or the crediting, they are in the deficit of amount, right? This is the scenario. Okay, is in middle of this, what we are having? We having the financial institution. Okay, like you can say there is a chain. Which kind of chain? The savings and investments are submitted into the financial institutions. Then the financial institutions make the credit or the borrowings to those who having the deficit of amount. Okay, so you can say this makes the bridge, or you can say mediating between the savings or savings or investment, and the borrowing and the crediting. Okay, so this is the first thing we have seen. All right, like it is a mobilizing. Mobilizing means moving from axis to the deficit. Second is what we have seen. We have seen that parts of it, like it includes the banks, NBFCs, insurance companies, pension funds, and the stock exchanges. Okay, so whenever we talk about this kind of things, like we have discussed here, saving, investments, borrowing, credit is, so always in our mind, two things come up. Two things come up, 1 and 2. First thing is what? First thing is stock market. Okay. Second thing is bank. These two things comes in our mind. Like stock market, in stock market, there are the you can say participants who having the savings and the investment with themselves, and then they are making the you can say money to those who are in the deficit, or you can say they are purchasing their shares, bonds, debentures, whatsoever. Okay, so this is stock market. Banks, we know that we are the depositors. We submit our amount in the bank, then the bank will lend out the amount to the borrowers and the creditors. Then they will earn the interest and they will pay us the interest. This kind of services we have discussed in the previous lectures also. Okay, but here you could see that apart from them, there are other names also, like the non-banking financial companies, insurance companies, and the pension funds. Okay, so how they operate in this sphere, we will also discuss this in the series of that particular lecture. They provide essential financial services to individuals, businesses, and government entities, contributing to the overall growth and the stability of the economy. Okay, the Reserve Bank of India is the central regulatory authority overseeing the function of financial institution in India, ensuring compliance with the regulations and promoting a sound and the stable financial system. Okay, so basically, if we talk about this, then we know as per the RBI Act 1934, the RBI was established in 1955. Okay, right? Thereafter, as per the Banking Regulation Act, okay, 1949. What happened? The RBI was nationalized and became supreme authority to control and supervise the financial system. Okay, so please remember these two terms. RBI Act 1984 makes the way for the establishment of RBI in 1935, whereas the Banking Regulation Act 1949, it's basically responsible to make the RBI as a nationalized bank and gave him the supreme authority to control and supervise the financial system. By virtue of this, it has got the control of banking institutions, non-banking financial companies, NBFC, okay, developmental financial institutions, and the financial institutions. Okay, so if any of them covers under this one, Okay, so ultimately this thing will comes under the RBI. Okay, or you can say RBI jurisdiction. Okay, so now here we have finished the basic introduction of the financial system. Like we have seen that they are responsible for mobilizing. We have seen what type of institutions comes under the financial institution category. We have seen that what is the regulator of the RBI and such kind of things. Okay, now let's move forward. Another thing, we have the departmental financial services. What do you mean by this? Let's start. The Department of Financial Services oversees the operation of banks, insurance companies, financial institutions, and the national pension system in India. Okay, so please remember that the Department of Financial Services is tasked to oversee the banking operations, insurance company, financial institutions, and the national pension system in India. Got it? The department comprises 13 members and it's headed by the Financial Secretary FS, who is supported by the Additional Secretaries AS, and Economic Advisor EA, and 7 Joint Secretaries JS, and the Deputy Director General DDG. Okay, so please remember that total strength is 13 members. Okay, the bifurcation of this is Financial Secretary, okay, 3 Additional Secretaries, Economic Advisor, 7 Joint Secretaries, and Deputy Director General DDG. Okay, so please keep this thing in your mind. Responsible for managing significant government programs and reforms related to the banking, insurance, and the pension sector, the DFS, or the Department of Financial Services, focus on the initiatives such as social security, financial inclusion, and using insurance as a risk transfer mechanism. Okay, so about insurance we will see in the further course of this lecture. So about social security, it means that pension and all. Financial inclusion means providing credit to the underbanked section also. Okay, it also prioritizes ensuring credit flow to the critical sectors of the economy, farmers, and the common man, and all of them also called as which one? How they called? How do we call them? Okay, which sector part are they? They are the part of priority sector lending, also known as PSL. Okay, all of them are the part of priority sector lending. Okay, so here we have taken the introduction of the Department of Financial Services. Now we have the another term which is known as the classification of institutions. Okay, like how do we classify these financial institutions? Okay, so first is the term lending institutions. Okay, these institutions primarily engage in direct lending through term loans and the investments. Okay, so basically remember, when we talk about the terms, when we talk about the terms in finance and in the economy. Okay, so term is basically signifies 2 areas. What are these areas? First is short term loans or short term credit. Okay, another one is long term loans or long term credit. Okay, so basically term signifies the loans and the credits in the world of finance, while in the economy it is related with economics of scale and production. All right, so because we are talking about the finance right now, so we will talk about this one: short term loans or the short term credit, long term loans or the long term credits. Okay, so basically if we go deep down in this, then we could say first is the short term, second is the long term. Okay, going by this, short term is always less than a year. Okay, this is always more than a year. Okay, so remember, short term loan is provided for less than a year, while the long term loan is provided more than a year. Got it? That's we call as a terms. Okay, so basically you can say the term institutions are those institutions which are intended to pay loans for the long term, or you can say more than a year basis. Got it? So that's why these are known as the term institutions, and they generally provide the loan to the markets like the real estates, okay, constructions, all right, like the infrastructure, okay, heavy industries, all these kinds of areas. Why? Because these areas could not be sustained on the short term basis. The loan and the credit they required for years, 10 years, 15 years, 20 years, 40 years. These are the minimum years they are, you can say, looking for the loan or the credit facilities. So if the institution is offering on the short term, or you can say loans or credit for less than a year, then it will not beneficial for these areas, because they could only be sustained in the long term, or you can say more than a year basis. Okay, so that's how the terms or the term institutions signifies. Thereafter, refinance institutions. Examples include the National Bank for Agricultural and the Rural Development, NABARD, Small Industries Development Bank of India, SIDBI, and the National Housing Bank, NHB. These institutions primarily provide refinance to banks and the non-banking financial institutions. Okay, so like if we talk about this, okay, so about refinance, we have already discussed that refinance is a condition. Suppose this is the borrowers, okay, this is the lender. All right, so you can say, suppose if rupees 100 crores was the total amount the lender had, out of this rupees 60 crores was granted. So how much left? Only rupees 30 crores left with the lender, right? That's the scenario. But he has the need of 100 crores. So in such a scenario, the refinancer will come in the picture, and the refinancer will provide the 60 crores which have been granted to the borrowers, because the borrowers will be able to return the amount back to the lender after a certain period of time, or you can say after the fixed duration. Okay, so that's how the refinance works. We had already discussed the refinance in the previous lectures in more details. But here is one thing. If you look all of them, what you are seeing and what you are getting, just try to think about it. What you are seeing and what you are getting by seeing all of these names here. So basically, if we look all of these names, what we are getting, that these all are the head institutions of certain sectors. Okay, these all are the head institutions of the certain sectors. Okay, like NABARD, SIDBI, or National Housing Bank, if we talk about them only. Okay, NABARD, SIDBI, NHB. NABARD is for agricultural and rural development. Okay, SIDBI is for small scale industries, right? Whereas when we talk about the NHB, NHB is for housing sector. So these all are the heads. That's why they are offering refinance services. Okay, so keep this thing in your mind. Now let's move forward. Investment firms. Firms like the Life Insurance Corporation or the LIC predominantly invest in the marketable securities. These all are also called as a state regional level institution. So here we are seeing the word which is called as the investment firms. Okay, by name we could conclude that the investment firms are those firms which are making the investment. But when we are looking here, Life Insurance Corporation or the LIC, so we know that this particular firm is basically involved in which thing? Insurance sector, right? Insurance sector. So now the question is, if this firm is involved in the insurance sector, okay, so why we are calling it as an investment firm? Why we are calling it? That's the main thing. Okay, so basically if we talk about it, all right, so LIC basically invest in some areas. And what are these areas? Like 1, 2, 3, 4, 5. Okay, first area is infrastructure investment. Okay, second is government securities. All right, thereafter the equity investments. All right, then the debt instruments, then the establishing financial markets. So these are the areas in which the LIC, you can say, invested. Like if we talk about the infrastructure projects or the investments, okay, so the projects which are generally based on the PPP model, public private partnership. Okay, oftenly we call it as a PPP model. Okay, when we talk about it, so basically what happens in PPP model? The public firms and the private firms come together and then do a business. Okay, so in the infrastructure investments, the LIC plays the role of the public firm. Okay, got it? Thereafter, the second one is government securities. Okay, we know that the Reserve Bank of India or the RBI, on behalf of the government, the RBI issues the government securities to the market. We know that. All right. So basically, LIC is one amongst the buyers which buys the government securities. Okay. Thereafter, if we talk about the equity investments, about equity, we had discussed in the previous lecture. Like we can say, equity, non-equity, right? What is the difference between them? What is the meaning of equity and what is the meaning of non-equity? Come on, tell me. 10 seconds I'm providing you, then I will give you the answer and your time starts now. Just think about it. We had discussed this in detail, so I want a right answer from all of you. Okay, so the time's up. If we talk about equity, then it provides stakes and ownership both in the company or firm. All right. But when we talk about the non-equity, then provides only stakes and no ownership in company or firm. Okay, like when you are making the equity, it means that you are getting the ownership and the stakes both. Okay, you can participate in the company's management. You are entitled to get the dividends on higher profits, and also you are entitled to suffer a loss on the lower profits. But when we talk about the non-equity, it only provides the stakes and no ownership in company or firm. Okay, it means that what? What does it mean? It means that you are entitled to get the fixed return. Okay, you have on the stakes, but you are not allowed to participate and interfere into the company's management. Okay, so that's how the LIC basically purchases the equity investment. It means that LIC gets the right to participate into the company's management. Thereafter, what we have the debt instruments. Debt instruments means like purchasing debentures, bonds, and all. All right. LIC also purchases them. And then we have the stabilizing market of financial market. You can say whenever the financial market is suffering the, you can say, lack of liquidation or lack of liquidity. Whenever this is the market condition. In this scenario, the LIC will come into the picture, all right, and then will provide the liquidity to the market. Okay, so that's how we have seen this thing. But now the question is, why LIC doing all of these kind of things? Like we have known that the LIC is basically the insurance firm. Okay, but why then they are doing this? If we talk about this in a particular matter, LIC is basically the fund pooling company also. Okay, like LIC is not only limited to the insurance, they having so many programs. Okay, so their fund pooling program in which they promise that if you invest and if you can say pay this amount to us, we will make it this amount to you back. Okay, so this kind of things basically comes under the fund pooling. All right, and for this, through these areas, by investing in these areas, LIC earns the profit and then distributes the profit accordingly into the shareholders, or you can say into the policy holders basically. Okay, So that's how they work. So this is the investment firms. All right. So students, basically in this lecture, we have, you can say, studied till now, till the classification of institutions and the investment firms. In the next lecture, we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.